Rajat Sharma also joins us on the show right now. Rajat, hi, good to be speaking with you. What do you make of the strength today that we are witnessing on the likes of HDFC Bank, Kotak Mahindra Bank, etc.? Is it finally the time for them to outshine?
Yeah, good afternoon. Thanks for having me on the show. So, I'll first give a disclosure. I don't have any of these large cap private sector banks in my portfolio. That said, for once, I do agree that HDFC Bank, Kotak, IndusInd, all of these banks are actually at a price where you could consider adding them to your portfolio, at least in an incremental way. So we are doing that, and the reason is two things have changed for these banks. First is that if you see historically, they've not been trading at the kind of valuations they used to trade about 5 7 years ago. An HDFC Bank, which consistently traded at around 27, 28, 30 kind of price earnings multiple, is today available at 18. The other thing that's happened is that RBI governor has been talking about credit growth being a problem and low CASA deposits at these banks. So credit deposit was a little skewed, and I think with the latest budget where there is no advantage of investing in debt funds from a tax perspective, a lot of investors and institutions in particular who were parking money in debt funds, which were very tax advantaged, that money is likely to move back into the banking. So, the banks would have a lot more raw material to extend and, you know, uh, give out advances. So I think that will change for these banks. So now if you see the overall banking space, when you compare private banking to PSU banking, which has run up a lot, the PSU banking, I do believe that stocks like Kotak and HDFC, which have basically given what 30-40% return in the last 5 years, these are now available at a very good price point, and you should start adding them slowly. So I think what we're doing is we're going back to the drawing board, moving away from a lot of these overheated stocks, especially in PSU and defense, and coming back to what I would call as a core portfolio, which is your large cap private sector banks. One theme that I'm really positive on is FMCG, again a sector which has not done as well as the market. So that's my broad view on the market.
Where would you be taking off profits if the markets were to fall further?
Taking off profits if markets were to fall further. So if you're not sitting on any fixed income or cash, I mean, if you're not invested in fixed income instruments, if you don't have money to buy into a dip, then definitely do that. Having said that, I've been sitting on a lot of cash positions for almost 6 months now. So today my portfolio is around 38 to 40% debt across clients. We deal with different clients, but overall, broadly, if I see my total asset size, a lot of it is already dry powder. So I would suggest taking off profits, not waiting for the dip, taking off profits now, but to the extent incrementally invest in equities. That's where I'm saying what you should be looking to do is sector rotation. And I think sectors which I like a lot are, again, now private banking looks attractive. FMCG is where we've done a bulk of our buying, whether it's Asian Paints or Hindustan Unilever. ITC, which reported numbers, they were pretty flat, but I think there would be a lot of value unlocking in the next 100 days as hotels business gets listed. So these large cap stocks in FMCG, private banking, and even for that matter, IT. Don't compare it with what's happening in US, where a lot of the IT stocks, particularly Nasdaq, went up. A lot because of the whole artificial intelligence boom. If you look at Indian IT stocks, which are still very traditional, legacy businesses, you have an Infosys which is available. It's got a dividend yield of around 2.5% right now. So that's again a sector where you should look at adding. So basically, frontline stocks from sectors which are fine available at reasonable valuations and moving away from PSUs, defense, and a lot of these things which have run up a lot.
Just wanted to talk a bit more about UPL because the presentation is out, and interestingly, they haven't given any update with respect to the FY25 guidance. So I'm not sure whether I should read it that they are maintaining the guidance and there's no change to that, hence they have not updated it, or that they have taken it back. That's just something to watch out for, because in the earlier presentation that they had given at the end of Q4, they had talked about 4 to 8% revenue growth. EBITDA growth was expected to be over 50%, and the operational free cash generation that they were likely to do in in FY25 was $300 to $400 million. Right now, we don't have any fresh update coming in with respect to the FY25 guidance. But yes, there is an incremental comment about FY25 wherein they are saying we continue to focus on margins, the benefit of which is expected to get more pronounced in the second half of the year. Our focus is on cash generation and that continues, and we're optimizing our inventories and other working capital items. So they are saying that they're working towards it, but as of now, they haven't given any fresh numbers for us to talk about as far as the FY25 guidance is concerned. So that's about UPL right now and the kind of updates that we are getting from the earnings there. But talking about earnings, we have a whole host of them lined up for later today as well. Titan, of course, will come out with its earnings. Let's take it across to Vinny to get a sense as to what the expectations are. Vinny, the stock is at the highest point of the trading session. Any recovery that we are anticipating as far as the jewelry business is concerned?
Yes, so the jewelry retailer Titan is expected to report its numbers. We're expecting a revenue growth of around 5.5%. Profits expected to be quite muted this time, while margins expected at 10.2% versus 9.9%. Jewelry division, which accounts to almost 80% of their revenues, that's expected to see a growth of around 8%. This time, what the impact was coming in for the jewelry business was that the wedding season, there were lesser wedding days as well as volatility in the gold prices is something we are watching out for. Jewelry EBIT expected to be lower due to studded sales being lower because lesser wedding seasons. We're expecting watches and wearables to continue to see a good growth. Obviously, the company had come out with its Q1 update, so we have a fair idea of what to expect across segments. Eyewear segment 10% growth, watches wearables around a 14% growth is what we are watching out for. Watch out for demand trends in Q2. How is that shaping up in terms of commentary? Profitability across segments, what's the trend there? As well as what is the competitive intensity and product mix one is expecting going forward are key factors to watch out for from Titan.
Okay, and Vinny, tell us what to expect from Britannia's numbers as well.
Yes, so Britannia is set to report its numbers. Now, in terms of expectation, we're expecting a revenue growth of 5%. And in this, there's a pricing cut that Britannia had taken as well. So, volume growth are expected to be at 7% because there's a negative pricing cut. So, pricing growth will be negative, but we're expecting volume growth of 7% this time around. Now, obviously, price cuts is something that must have aided the shares. Market share of the company is what we are expecting. So, market share gains will continue from Britannia even in this quarter is the expectation. Some bit of an adverse impact due to the harsher summer that one could be watching out for because that was dampening the hot beverage, and in turn obviously biscuits is something that could have seen an impact as well. Margins 18.3% versus a 17.2%. Margins are going to be aided. Why? Because there was a soft base last time. So because of that, an 18.3% is what we're expecting the EBITDA margin at. Let's watch out for commentary, especially in terms of market share, commodity outlook, as well as what is the pricing action they've taken in Q1 or expectation in Q2 is what we're watching out for. Volume growth as well as the Hind belt, rural versus urban growth, how is that shaping up are key factors to watch out for.
Right. Rudra, what's looking like a better defensive bet? Is it the obvious pharma, which seems like a good hiding place? Or would you say some of the FMCG plays as well are looking good?
See, for me, definitely private banks are much better at current level. If someone wants to hide in this fall, I would rather go for might be Kotak Bank, HDFC Bank, Indus India Bank. These are all stocks which are very close to their very strong support, and even valuation wise, I have comfort in them. So, for example, HDFC Bank, see the outperformance today, and also support is at around 1636.40 zone, which is very strong. And even in public sector bank for that matter, you have to be very stock specific. Stock like PNB for that matter, around 117, 118, we have a very, very strong support. SBI at around 840 offers a great risk reward to go long. So if I have to hide in this market and buy every dip, I'll be looking at buying number one HDFC Bank, followed by Kotak Bank, ICICI Bank and Indus India Bank. And when it comes to PSU banks, I'll be picking SBI and PNB because all these stocks at current level offers great risk reward to go on the long side, and their bottom is very much protected and they're very close to long support area.
Talking about banks, SBI is all set to report its numbers tomorrow. Let me take it across to Snehi, find out what the ET Now poll is pricing in. Snehi?
Well, yes, all eyes are going to be on the biggest PSU, SBI, coming out with its Q1 numbers. Let's take a look at what the street is factoring in when it comes to this PSU bank's numbers. On the standalone basis, let's first talk about debt interest income. That's expected to come in at 42,292 crore rupees, which is a 9% uptick coming in on a year-on-year basis. PPOP, which is the operating profit, is also seen at 25,698 crore rupees, which is an uptick of 2% year-on-year, but a drop of 11% sequentially. Now, when you talk about provisions, that are being seen at 3,197 crore rupees, coming around this time 28% higher year on year, but almost double on a quarter-on-quarter basis. So watch out for what this number looks like. And net profit also expected at 16,786 crore, which is a drop of 1% on a year-on-year basis, a 19% cut coming in sequentially as well. Now, when we talk about NIMs are likely to moderate 3 to 4 bips sequentially to 3.27%, somewhere around that number, due to tight liquidity. Employee cost is likely to normalize this quarter as well, but other income and fee income is likely to remain weak. Thereby, PPOP is expected to grow 2% year on year. Now, Q1 is seasonally weak for agri loans, thereby slippages are likely to increase to roughly 8,500 crores coming in, and as a result, we can expect some impact to show on the PAT as well, which is most likely to remain flat year on year. That 1% cut coming in is what the street is penciling in on a year-on-year basis. Now, when you take a look at advances and deposits, advances growth is likely to remain strong at 16%. Loan growth is likely to outpace peers as well. Now, SBI loan growth has been strong at 4 to 5% sequentially over the last 2 quarters. So we'll watch out for if this momentum continues. Deposit growth is likely to remain at that 10% year-on-year mark as well. Talking about asset quality, NPAs are likely to remain stable this quarter. Credit cost is also roughly expected to be somewhere around that 35 basis point marks. Now, what are the important things to watch out for? Is going to be commentary on deposit growth, agri book and its impact on the asset quality will also be important to watch out for. Implications of the RBI's new draft circular on LCR ratio. This is going to be one very important cue to watch out for, and what the management has to say about this in its commentary, and any view on direction and trajectory of NIMs will also be key to watch out for. So, well, yes, this is what the street is factoring in for SBI.
Okay, we'll watch out for SBI, and of course the chairman will join us at 2:15 p.m. tomorrow, so stay tuned to ET Now. Even on a Saturday, we have earnings coming in thick and fast, and we will be analyzing the SBI numbers for you tomorrow. But Rajat, what do you make of industrials? They had heated up quite a bit. Today, of course, Cummins is under pressure. The commentary from the parent isn't very impressive. Do you think it marks a reversal for some of these industrial names? Because even the allocation in the budget didn't really enthuse the market as such.
This actually, I can extend the point I was making earlier about stocks and sectors which look overvalued. Industrials and infrastructure as a whole is looking a little stretched. However, I will first give a disclosure about a stock that we've added to our portfolio this week, which is the Heidelberg, and it's a cement company. Cement as a business fits perfectly within my investment style. It's one sector which will never give you losses. Temporarily a stock may go down, but the long-term fundamentals are, always good. Now, Heidelberg as a stock has a dividend yield of around 3.5% right now. And what I think a lot of people are missing, it's available at a price earnings multiple of 30. And, cement companies had a major dip during COVID when everything was shut. And since then, this is one stock which has improved its earnings per share. The EPS has gone up, and the recent numbers, they reported a 70% jump in their EPS to 7.3. And that's a very, very healthy growth. These stocks are trading at a discount. So this is one stock that caught my attention, and I felt this is somewhat missed by the market because given the way they improved their profitability, it's a debt-free company. Cement company which is looking to expand, it beats me. So we've added that to our portfolio. Again, even if and they've been a consistent high dividend payer, even if markets were to fall, I don't expect this stock to fall as much. But overall, industrials and infrastructure, I look at the sector as one. I find most of the stocks like L&T and stuff trading at extreme valuations. There's been a lot of talk about Cummins. I've not really looked at deeply into the stock and why the stock, but for that reason, it'd be wrong for me to comment.
Rudra, I want you to come in on some of these, cap good plays, right? L&T, Cummins, etc., especially the kind of weakness that we are seeing today.
definitely an avoid in these stocks and specifically in the cap goods sector. So these stocks have run up too much, and at current levels, whether it is cap goods or even for that matter autos, is a very clear avoid. And you can in fact look at stocks where the results were good, and in fact these stocks are available at current market price much cheaper in terms of even valuation. Chart wise, they're also good. I can give a lot of names. For example, look at GAIL. The numbers were very strong, and GAIL at current market price offers a very good buy. Similarly, look at MCX. Numbers were very good. Again, stock is available at very good valuation also, and at current market price is a great buy. And even in markets like today, these are stocks which are showing relatively good strength. So you have to pick in you have to be very stock specific and sector specific. For me, private banks, FMCG, pharma, so these are IT for that matter. These are sectors where I will pick my stocks. And if I have to name some more, look at even Tata Power, look at even McDowell or your United Spirits. These are stocks which are showing a lot of strength, and relatively they are far, far better. So if I have to hide in this fall, I will go to these sectors and few stocks which I have named now.
Just taking a look at the market, because there's a further weakness that has creeped in the last 10-15 minutes. We were holding about that 24,770 mark, but right now we're at 24,730 thereabouts. So very close to the lowest point of the trading session, if not the lows. Actually, the lows of the day was around 686, which happened earlier in the day. But for now, at least, we are towards the lower end of that range. Kunal, what do you make of this bout which is coming in further? Would it mean that this weakness will perhaps continue come next week also, and any BTSC trade that you would want to carry forward?
Yeah, I think the selling is probably because of the weekend, and traders would want to close on to the positions even if it was built on an intraday basis, because because of the uncertainty across the globe, and selling which is there consistent in the Dow futures. But in terms of BTSC trades, I'll still suggest to buy calls. The first one is Ban Kaplan point. We were discussing this stock earlier. The stock breaking past about the 1600 barrier, coming back towards a new life high breakout about those 1600 levels. So would suggest a target of 1700 on the stock, and stop loss could be kept at the breakout point of 1600. And the second would be a Ban M&M Finance. The stock is holding on to the 300 levels broadly, in even though the futures is into discount, but I would still believe that the stock is completing a breakout of a swing pattern as well as a cup and handle pattern on the daily time frame. So would suggest a buy with a target of 330, stop loss at 288.
Right. And Rudra, what about your BTST ideas?
Tata Power looks very good, and at current market price, it's a buy. Dips to levels closer to 440, 445. Even positionally, one can accumulate this stock. Looking at targets of 475 with a stop loss of 460. Manappuram is also another counter which looks relatively stronger to me. Buying with a target of 218 with a stop loss of 208.
Taken. Just wanted to flag out some of the other major events which are lined up in the coming week, and they'll be important to track as well. You have the Monetary Policy Committee meeting coming up, so the decision will be out on August 8th. That, of course, will chart the course for us, because the RBI commentary of late has been fairly important for banks and the kind of measures they have been coming up with. So the press conference after that will also hold the key. On August 9th, we'll get the AMFI data, or the monthly mutual fund inflow. We have been seeing a number of almost 20,000 crore a month. Does it increase? Is there any softness there? That is something to track. We'll get the SBI board fundraising announcement, which is expected to happen over the weekend. And then Ola Electric will list in the coming week. A lot of other listings also lined up. But of course, Ola is the one which the street has been waiting by for. So we'll watch out for that. Earnings, yes, there's going to be Divi's and SBI tomorrow. ONGC in the coming week on Monday. And then Bharti Airtel also comes out with numbers. So we'll watch out for some of those. But Rajat, wanted your take with respect to the earnings season so far. Yes, there have been quite a few disappointments, one can say, but has there been anything which impressed you particularly, any stock or any segment or sector?
Yes, definitely. Broadly, if you ask me, earnings have been, to my mind, the stocks that I'm looking at, whether it's ITC yesterday or Tata Motors and stuff, everything that I track and I have in my portfolio is in line. The thing is, oftentimes people try to buy stocks which, have underperformed or are not performing very well. But looking at Tata Motors numbers, I thought this is one stock we should add more of, because despite really, really strong growth in their profit, the stock is underperforming. And again, this is, one of those things that, it's not in line with estimates. But, I was just, in fact, looking at it right now. Their profitability has gone up from 60 crores to 30, from 3,200 crore to 5,500 crores. So, very strong numbers. They've got, pretty much the leading market share in category passenger vehicles. They've got 3 frontline vehicles. They've got 5 more lined up, and that's about 14% of their revenue, the passenger vehicle category. I think that bit of the pie is likely to go up. So despite the run up, the stock right now looks cheap. If you forget about what the stock has done in the last 1, 2, or 3 years, if you just look at the fundamentals in like a snapshot as it is today, it's trading at a valuation of around 13. This is the future. EVs are coming in. Their JLR business is doing really well. They've got electric vehicles in both Jaguar and Land Rover. They've got some 33,000 advance interest bookings in that. So everything looks really positive for the company. Again, the only down is the fear that everything is overvalued and could fall. This is one stock which is not overvalued, but given that it has such high weightage in many of the indices, it would probably fall in line with the markets. But this is definitely some stock. Again, to the extent you're adding incrementally into your portfolio, you should add that. If I may make one more point that I was, talking about earlier, why I was saying FMCG is something that we are very positive on, and we were talking about the MPC meeting. Of course, there's going to be no rate cuts at all. The food inflation is up some 12.5%, so that's not going to happen. I hope they don't increase the rates, really, to be honest, at this point. But this is a very seasonal phenomena around monsoons. The food prices go up, so there's food inflation. This would again help FMCG companies as we go into the later half of the year, as inflation stabilizes and their input costs improve. We have a sector which is already trading at very cheap valuations, and inflation is set to go down. So you can expect the second, third, and fourth quarter for FMCG companies to be very robust. So definitely look at buying stocks in that. Stocks, the ones that I've mentioned, we've added HUL and Asian Paints. Definite adds at this point.
You were talking about, Rajat, ITC, right? The stock that you were recommending just before that?
I spoke of 3 stocks, Hindustan Unilever, Asian Paints, and ITC, of course. ITC, again, reported numbers. They were pretty flat, as expected. But I think the big thing that will happen for ITC is that in the next 100 to 150 days, the hotels business will list as a separate entity. And we've seen whenever that happens in a company, there is some bit of value unlocking.
Because you are right there. Just 2 minutes to go before we wind down for the week and the day. I'm going to quickly hand it over to Snehi.
If you like this video, then like, share and subscribe to ET Now.